We have 13 weeks of pure excitement, pure learning, pure sharing, doing business together, bonding.
Idea extraction is your bedrock to building a profitable business.
Your business has a value, you have worth, and you need to be able to set your price. No matter how great the product is, it has to be marketed. If you have the cure for cancer tomorrow and you don't market it, no lives will be saved. Think about the challenges that we have and why your product or service is going to fill that.
You are the brand. We have to find our own unique value proposition.
At the end of the day, business is about money. And the big question you're always going to get, who is going to pay for this and how much money is it going to actually produce?
The only thing that you need to do is not give up.
This is going to be an exciting ride, ladies.
Actually have lots of revenue, you can have lots of profits, but you might not be able to pay your taxes, or you might not be able to pay your salaries and wages that fall through because there's no cash in the business. Because how we account for it and how we do business is basically under what we call the accrual method, which is where you recognize revenue when you earned it and you recognize expenses when you incur. So you can buy and credit all the stuff you need. You can sell and credit all the stuff you can sell. You will show a book profit in the accounting sense, but there will be no money in the bank to pay taxes, which you must pay in cash, and to pay your salaries, which you must also pay in cash. So just remember these three buzzwords. The revenue is vanity, profits is sanity, but cash flow is the reality. I'm going to spend some time this evening on cash flow. Let's talk about a little definitions so you understand where we're going. So when they say follow the money, we're talking about your business model. Every time you have an idea and you want to convert that idea into a business, one of the first things you want to ask yourself is how you plan to make money. How is the business going to generate money? Because that's why you're going into business, to make money. Whenever you ask that question, it's the same as asking, what is the business model? So when somebody says to you, what is your business model? You say, okay, I'm an accountant, and what I do is provide accounting services to businesses who want to be in compliance with the government tax rules, etc., etc. And so I charge a fee for those services, and that is how money come into my business. And then I have to pay for stationery supplies, office rent, utility, etc. That's how the money go out to the business. So my business model is providing my skill set as an accountant to make money. Finance is how cash, or actually how resources, not just cash, but how resources move through the business. It tends to focus heavily on cash, because when you do finance, even if you start with a good or you provide a service, you want to convert that good or service into cash. And then you use the cash to do other things that generate more cash. So whenever we talk about finance, we're talking about how we manage money specifically, and generally how cash moves through the business. What's the funding of the business? And there are a couple of tools and stuff that we can use for that. There's cash, there's checking your money, e-money, you got mutual funds, pool investment, you got money market, short-term borrowing, you've got bonds, which is debt instruments, you got equity. And when we look at one form of business formation, we talk about shares and stocks of shares. You can do leverage financing, where you use other people's money. That's what leveraging means. You use other people's money to do stuff. Derivatives really cover a whole bunch of other tools that derive their value from the market. So when somebody say, "Oh, we have got this derivative and it's an interest rate swap, or it's an asset-based obligation or something like that," all they're really saying is that the value that these instruments is recognized at actually comes from the market itself. And sometimes you don't know the value of those instruments until something happens or something does not happen or a certain time frame passes or does not pass. And that's why they call them derivatives. And you can always use insurance to edge your risk that you face. The president mentioned earlier, risk, and a risk is always something that may lead to you're losing money. Whenever you talk about risk, you're basically talking about what is the potential that you'll lose money or the potential that something perilous will happen. And in everything we do, in life and in business, there are risks. And then there are ways of managing those risks and ways of mitigating those risks. And insurance is one of the tools through financing that we can use to manage those things or mitigate them. Okay, so in terms of finance on the stock exchange, when you have an idea and you want to quantify that idea, to take it from your head and turn it into something that will turn into cash, there are actually 3 legal forms that it can take right now. You can either do it as an individual, which is what a whole lot of businesses start, especially small micro businesses or small mid-sized businesses. It starts with an individual and you do some stuff. And then it may grow, expand, scaled, and you ask another person or persons to join in, and you create a partnership. And then the business itself might grow so huge, you need a whole lot of capital to scale up and to do other things. And you may incorporate that business into what is called a corporation. And the corporation is the creation of the state. It's a law. It's by statute to say you have a corporation, so you incorporate it, and there's a process that you go through to incorporate that business. And once it becomes a legal entity, one of the benefits of that is you have access to a whole lot more funding by going on the stock exchange, where you can sell your shares, or you can actually sell debt instrument to bring money in the business. And it can be either a profit corporation, in non-profit like a charity or a club or an association, or it can be some type of governmental organization like schools and hospitals and public bus services and that sort of stuff. And all of these, so these are the 3 main forms you can have. You can either do it as an individual, and when you do it in an individual, you're exposed to a tremendous amount of liability if something go wrong, because it's about you, but you face the risk and you face the reward. You alone get all the funds when you do make money. When you go into a partnership, you tend to spread the risk around. More people are involved, and so the profits are shared, but the risk is also shared. And then when you go into a corporation now, it's a different kettle of fish, where the actual ownership of the business is separated from those who manage the business and those who run it on a day-to-day basis. So in a corporation, you have the owners who own shares in the company, and then they may appoint or elect directors, and a board is formed to manage the company on their behalf. And then the board can employ workers and managers to do the day-to-day running of the company. Individual and partnership, you have no such structure. These people are head cook and bottle washer, and they do everything. But in a corporation, that's a little different. And each one of them have their own pros and the cons. So before I move on to the accounting fundamental, is there any questions, any stuff in the chat, Ujo, I need to look at?
For now, no. So we can continue.
Yeah, we can continue. Beautiful. So let's look at accounting fundamentals now. And I want to talk about the elements of accounting. Whenever you do a business transaction, whenever you buy something or sell something, give something or receive it, sign a contract or be party to a contract. Whenever there is a business transaction, let me just back up a little to define what accounting is. And this, I had this definition from the very first day I did accounting way back in the mid-70s. And I found it to be very useful with all the changes we have had. So accounting is the collection, collation, and interpretation of financial information or financial data. It's collecting, grouping, and then asking what is it it's saying to us? What message this information is now saying to us that we can use to decide whether or not we're doing the right thing, we're on the right track, how much money we have made, how much money we have lost, etc. So it's a collection, collation, interpretation of financial data. And in the process of doing that, there is 5 main elements to all the business transaction you can think of. Every time you do something, it will fall into one of these 5 categories. There's actually 7, but I'll focus on this 5, and then I'll explain number 6 and number 7 afterwards. So the first area is assets, things that you own or control, and you have the right to do what you want. So whenever you think of a business idea, I think about what next. You want to think about what are the things you're going to own, and those are called assets. What are the things you're going to control? So not just own it, but you can control it. You don't necessarily have to own it. But once you're in control, for example, if you lease a car, you don't own the car, but you're in control of that car during the time of the lease. So as long as you control it, you can decide how to use it, and you face the risk and you get the rewards. It's called an asset. The next one are liabilities. And it's anything that you owe, any obligation that you have. So just think about your personal life right now. And if you owe anything, telephone bill, utility bills, any stuff like that, you owe a mortgage or what have you, it is a liability. So again, as you think about your business, think about what you own and what you owe. Equity is what you bring into the business. That is your stake in the business. So the very first time you decide to do something, and you start with $100, that is the equity that you bring to the business. And there's another way to compute equity. If you look at the total value of all your assets, and you subtract the value of all your liability, hoping that the liability is less than the asset, the difference is your equity in the business. Number 4 is revenue. And that is any inflow of cash or resources. The business that you're in that's bringing in the bulk of the cash is called your revenue source. So if you're a consultant, for example, in HR, and whenever you get an engagement with a client and the client cut a check for that engagement, it's bringing in money, and you're in the business of HR consulting, that's considered a revenue. And an expense is actually outflow of cash or resources that support the revenue. And that's really, really important, because the president mentioned earlier, Nadine, about separating the business from your personal life. And that is very, very important, because expenses is not just all outgoing of cash or resources. It must be outgoing of cash or resources that has something to do directly with earning revenue. So somebody that's in an HR consultant, for example, if they've got an assistant that do the booking and type up the report and so on, that's an expense for earning the revenue from the HR consulting. But if you went out on a vacation with your family, you can't bill that to the company, because going on that vacation has nothing to do with earning the revenue from the HR. And I'm certain folks are going to say, well, what if I went on a seminar for HR and I also took a vacation? The key component here is that you need to be able to separate clearly the vacation expenses from that workshop or seminar you went to that is there to enhance your ability to do HR work. So that is called an expense. The other two items that is really not listed here, and it's when you do advanced accounting. They call it gains and losses. Those are the two other items, gains and losses. And gains are inflow of cash or resources from items that have nothing to do with really running the business. For example, you're in the business as an HR consultant, and you decide to sell some of your old furniture that you no longer need. You're not in the business of selling furnitures, but when you sell those furniture, you may have got $10 for it. So that is $10 coming in the business, but it's not revenue. So it's brought in the business as a gain. The opposite is true. If you had to spend money on something that had nothing to do with the business, for example, again, in the same selling of those furniture, if you had to literally give them away, so they cost you $50 when you bought them and you had to sell them for $10, so you lose $40 on them, that $40 that you have lost is considered a loss, not an expense. And then when we look at financial statements, you'll see how we separate gains and losses from running the overall business itself. Okay. And so let's look at how we would now, from a mathematical perspective, lay this thing out. Because you're not accountants, so you may not hope to be accountants, but it's good for you to know what is called a financial statement, which is really that document that tells the story in a quantitative manner. So visualize that you have made the letter T. And we call it T because the letter we call it a T account. So all of these things are collated, they're gathered, they're grouped into what we call accounts. So there's an asset account, there's a liability account, there's an equity account, there's a revenue account, there's an expense account. And all the like transactions are gathered, they're grouped under those various headings. And then we do a sum at the end of a certain period, probably a week, a month, a year. So visualize you've got what is called a T, you made the letter T. And you set out those 5 descriptions I gave you into an equation. You'll see that all the assets and all the expenses is on the left side of that equation, and all the liabilities and all the equity and the revenue is on the right side of the equation. Just as I said there, it's on the left side and it's on the right side. If you look at a T account, it's right here. Assets and expenses you put on the debit side. The left side is called the debit side. Liabilities, equity, and revenue is put on the right side, and it's called the credit side. Remember, again, I didn't say it earlier, but just to say it now, that accounting is the language of business. Whenever we talk about business, economics, finance, any stuff like that, the language we use is accounting language. And the description we use here is asset, expense, liability, equity, revenue. And so when we decide to collate them, to group them so they can tell us a story, assets and expenses is put on the left side and it's called debit. Liabilities, equity, revenue is put on the right side and it's called credit. So whenever you're talking to people and they say, oh, let's debit the account or let's credit the account, they're talking about taking a number and put it on the left side, or taking a number and put it on the right side. And one of the conventions we have in accounts is every time you put something on the left, something else must go on the right. Because every transaction has 2 sides to it. There's a giving side and there's a receiving side. So when you provide the services like an HR consultant, You're giving your services to the client, and in turn, the client is cutting you a check for receiving those services. So money's coming in, it's revenue. It goes on the right side of an account called consultancy fee. And then the other side, which goes on the left side of some account, this is an asset called the cash coming now is something you own, and that goes onto the asset side. So in the case of your revenue, you have credit going on the revenue account and debit going into the bank. And it's following this account, what we call the accounting equation. A plus E is equal to L plus E plus R. And later when we talk about trial balances and balance sheet, you'll see the same equation popping up again. So let's look quickly at one final session. This is the interpretation part of the report we're doing now. So it's a balance sheet. What the balance sheet shows is all the stuff that you own or control, which is called assets, must be equal to all the things that you owe, plus the remainder, what you brought in the business. And again, if you do it on a T account, the assets would go on the debit side and the liability and equity will go on the credit side. So whenever we talk about a balance sheet, they're literally saying you should balance the assets to the liability and the equity. So when you're doing your own business and somebody say, what is your balance sheet? First of all, you want to think of what is all the things I own or control. And that will give you a certain sum. And then think of what is all the things I owe. And that will give you another sum. And the difference between the two is going to be your equity in the business. And hopefully it's positive. And they tend to call that net worth. When somebody says, what's your net worth? It's the difference between the assets and the liability. And the sum of those two should equal. So let's look at what a real life statement will look like. So this is a balance sheet, and it's comparative. And balance sheets are always at a moment in time. Now, what they've done here with the T account, if you look at it good, you'll see that all they've done is take the liabilities. They've taken the liability part, and they have just gone ahead and move it about 90 degrees to the left. And so they have the assets at the top and the liabilities and the equity at the bottom. And this is a new format. They call it the vertical format. Way back in the 70s, when I started accounting, it was actually the horizontal format, where you actually have assets on the left and liability and capital on the right. And as we transition over the years, they've just pushed it down and put it at the bottom, and now it's vertical. But you'll notice that the total assets, both the current and the non-current, is 953,901. And the total liabilities plus shareholder equity and retained earnings, 563,901. So that is why they call it a balance sheet. Total assets balanced with the total liability and capital. And these are some of the elements of the balance sheet. There's a trust account, there is a capital asset. These are like furnitures and fixtures and trucks and machinery and that sort of stuff. Then you have a bunch of liabilities, overdraft, taxes payable, long-term accounts payable, such as summing up to 769. Then you've got a mortgage and you have a shareholder loan, because sometimes the $1,000 that you start the business with, you need to put in much more money, especially if you incorporate the business and it's a separate legal entity. And that's sum to $1 million. And then you have the shareholder loan that you start, the shareholder shares that you start with 100. And this particular business have been losing money over the years. And you don't want to start your business, and this is what you're seeing here. But this is what a typical financial balance sheet would look like. Now, the use of current and non-current. Everything is current if it happened within the next 12 months. So what is up here is the cash you have available for the next 12 months. Anything that's non-current is enduring. This value here would last for more than 12 months. And that is why we call it non-current. Likewise, in the liabilities, you can see the bank overdraft. You expect it to be cleared before the end of 12 months. You certainly expect to pay the government their taxes within days. The accounts payable shouldn't last longer than 12 months. Trust fund liability, and if you're having a lawyer in the group, they'll know exactly what that is. You know, that's funds that you owe in retainer on behalf of your clients. And you have your line of credit and your credit cards, and this current portion of the mortgage. Now, the mortgage lasts for more than 1 year. It's probably a 25-year mortgage, but in the current 12 months, this is the principal repayment that they'll make on it. So in the 12 months, they'll pay $6,260, and then over the remainder of the life, they'll pay $207. Then you've got the shares. Sorry, that's the original share equity that you started with, valued at $100. And as you run the business, you'll see where this negative, whenever a number is in bracket in a financial statement, it means it's a negative number. So the rest of the numbers are all positive, and once it's in a bracket, it means it's negative, which is not really good when you see negative in the retained earnings, meaning that they're not making profits over the life of the business. The next major financial statement I'd like to look at is this is one that most people are familiar with, the income statement. This is the one you see easily, especially when you're a sole practitioner or a sole proprietor. When you're in business alone, you tend to spend a lot of time on this aspect. Revenues less expenses equal to profit or loss. And if you go back to earlier slides, you'll see where we had assets plus expenses equal to liability plus equity plus revenue. So all we have done is that we have taken the revenue onto the other side and we have changed the signs around. So the profits that you make is the difference between the revenues that you have earned and the expenses that you have incurred. And hopefully you should have more revenue than expenses and you'll have a profit. If you have more expenses than revenue, then you have a loss, and that number would be in a bracket. And it followed the same concept of debit credits. Same concept of things on the left side, things on the right side. So this statement is called the profit or loss statement. And when we add to it gains, as I mentioned earlier, and losses, there is a second part that we call comprehensive income. So it's profit or loss and other comprehensive income. And the reason why they use that term comprehensive income is that is the total profits or loss that you'll have for doing business. But part of it has to do with the direct operations that you're in, which is a profit or loss section. And the other comprehensive income is that you can make money, or money can come in or go out due to other reasons, which has nothing to do with running the business directly. So they call it other comprehensive income. And let's look at what that would look like. Here again, they follow the same vertical method. So they start with the revenues, and they take from the revenues all your admin and operating expense, and then advertising. The difference gives you a profit before finance charges. Then this is a finance expense that is taken out, so we put it in brackets. That take you down to the profit. So from your 446, you take out all these expenses, including the interest, and now you're down to 41,000. And you pay $5,000 of taxes on that 41,000. So you're now left with 36,000. So you can see that this particular business in 2019 and 2018 made profits, 80,000 or 81,000 in 2018, 36,000 in 2019. However, if you go back to the balance sheet, you would notice that there was a loss there of 105,000. So what it means is that this business made losses early in its life, and now it's doing much better. And they're converting those losses down to profits, and the profits is removing the accumulated loss that you have there. Okay, any questions, queries, comments at this time? And here is a detail of what a typical expense would look like for that company, a summary of the expenses.
Michael, we have a few questions.
Certainly.
Yes, there's one from Marlene, and she's asking, should the business name or business product be patented for ownership and liability purposes?
Well, you don't need to patent it for that. If you incorporate the business, that is, you become a business that is owned by shares. That form of legal company has its own liability shield. So irrespective of the name you give the company at that stage, if you incorporate the company, then the only thing you can lose is the value of the shares that you invested. And that is generally speaking. If you run the company in bad faith, the courts can actually do what they call pierce the corporate veil. But let's assume you run the company in good faith, but you had bad luck and the companies go south and belly up and you had to shut down and you lose money. Creditors could not come to you personally because you have incorporated the business. In terms of the name, for individuals and partnership, if you have got a name that you think is very important and it's through that name that you make the bulk of your revenue, you can actually get a patent for that. So no one else can use that name legally. Or if they do, they have to pay you some sort of royalty, etc. And you could do the same thing too in incorporation. In fact, in Canada, when you incorporate a business, you can either go with a numbered company and the government will just give you a number, or you can go with a name company. And when you go with a name company, you have to do what is called a nuance search to ensure that that name is available. Nobody else is using that name. And if somebody else is using that name or a similar name, in the eyes of the government, you can't use it. So the answer is, you don't need to patent the name for the liability shield. You patent the name if you don't want other folks to use it.
Okay.
I hope that answered the question there.
Yes, thank you, Michael. Marlene, I hope that answers the question. We have a few more here before we go on. We have from Madison, and she's asking, should the balance sheet be prepared only on an annual or quarterly basis? How often should we update our financial statements?
Okay, that's a very good question.
Yeah.
In running the business, it is good from a management perspective to have monthly statements. But the law, the stipulation in the law is that an annual statement is what is expected. So your balance sheet for compliance purposes should be done at least once per year at the end of your fiscal period. And I use fiscal period careful now, because if you use January 1st to December 31st, you're on what is called a calendar year end. But if you use any other period and 12 months from that period, it's called a fiscal year. So if you started February 1st and you end January 31st, that's your fiscal year. And you have to file various returns with government 6 months after your fiscal year end. So yes, it's recommended, and it's actually in accounting rules and in the government act that annual report is what is considered. And there are four basic reports you do. You do the balance sheet, you do the profit or loss and comprehensive income, you do what is called a change in equity, and you do what is called a cash flow, which is what we're going to spend a little time on after this. And then you have notes to the statement.
Okay.
Individuals do have to do that because their life and the business is one and the same. Partnership, you have a separation because there's a partnership act that allow for general partners and limited partners, and they separate themselves, but they're also very exposed because at the end of the day, the partnership itself does not file a tax return. The partnership revenue and expenses are divided up based on the agreement between the partners, and their share of profit is then added to their personal life and it's filed like that. So the partnership itself doesn't pay taxes, but the individual partners do. The corporation is the only one that the corporation pay taxes separate from its owners, the share owners. And
Okay. Okay, there was a follow-up question that came to me privately, and which kind of just aligns with Madison's question. And the question was about who to do the accounting and financial statement. Do you advise that they do it themselves, or it could be outsourced? Is it one of those primary responsibilities that should be done in-house or outsourced?
Well, from my own experience, when you have a small business, small startup business, folks like to do all these things on their own. But you really shouldn't, because first of all, when you're running a real good, active business, your time is better spent on running the business, managing the business, looking at the projections, getting new clients, etc., etc. The second thing, though, is that accounting is actually a very, very precise discipline. And you should, when you grow and you can afford to, not necessarily outsource it. You can have people in-house that are employees that do the books and records. Or if you choose not to go that route, you can outsource it with people outside. They're not employees, they're like contractors now that does the books and records. But I, for one, would not recommend that as owner managers and that sort of stuff, you dabble into the detailed bookkeeping. What you should do is ensure that those reports, those crucial reports and matrices come to you at least on a monthly basis so you can see what's happening in the business. That's the interpretation part. You can look to see if your assets is growing or your liabilities are growing much faster than your assets, and therefore you're in what is called an insolvent position. Whether you're liquid or you're just, your accounts receivable and your accounts payable is almost the same. So that you're buying on credit and selling on credit and there's no cash. So my answer is no. I don't think you should do it on your own unless it's a small business and you're just in startup stage. But as soon as you mature and going forward, part of the growth and scaling must be to have specialized people handle your books and records.
Awesome, thank you. Next, asking, does a corporation need business insurance?
Everybody needs business insurance. Whether you're individual or a partnership or a corporation, because insurance is one of those risk allocation process. You can't get away from the risk, but when you buy insurance, you can help to mitigate the consequences of those risks. So whenever you're in business, you should seek to ensure that those things that are a risk that will shut down that business is properly covered through insurance or good internal controls. If you have good internal controls, some of the risks that you face, you can mitigate those risks with good internal controls. But even with good internal controls, there's COVID. So you need to have insurance for operation disruptions. There's a natural weather, snow, storms, etc., etc. There's theft, there's reputational risk. You're faced with all of these stuff, and insurance is a good thing. So whether you incorporate or otherwise, you should have insurance.
Awesome. We have Barbara here asking, when you are a corporation, is that when you can incur expenses in the name of the corporation versus when you are an individual? There is no distinction between you and the business.
And that is true. So as an individual, and I recommend folks, any business you go into, you should have a business account, a bank account for that business. I know it's difficult as individuals because you go to the bank and the bank choose not to open a bank account in the business name because it's an individual. But you should open a bank account and all the transactions that are associated with that business go into that bank account. So as an individual, you should have a separate bank account. It's going to be in your name, or some of the banks will allow you to open it in your name, but there's a trading as that they know it's for the business. Same thing as a partnership. Definitely as a partnership, because of the Partnership Act, it allows you to open an account in the partnership name, and banks will accept that. And definitely as a corporation, the corporation is a separate entity from the persons who own that corporation. And so the corporation has its own bank account. And when you read the Corporation Act, it will tell you that the owner of the corporation can actually sue the corporation, or the corporation itself can sue the owner, because they're two different entities. The owner just have shares in the corporation, but the corporation have a life of its own, and it's managed by the board. And it's annually that the board have a general meeting, and that is the time the shareholders have any say in running the business by appointing directors.
Okay, we'll just take one more question and then we'll go ahead with the practical part of it, because I'm actually looking forward to the cash flow part of your presentation.
Okay.
Natasha says, should solo individuals should solo individual ownership have business insurance? I believe you already answered that. Everybody should have business insurance.
Yeah, I mean, even in your own personal life, that's why you have life insurance. Things will happen. There's always a risk that things will happen that will lead to a peril. And insurance, when you have risk, there are a couple of ways to mitigate risk. You can avoid it, you can accept it, you can allocate it, which is one way, as we do with insurance. We can transfer it to other people. And insurance is one way to transfer the risk. So the risk is not disappearing. The insurance company has just decided to assume that risk on your behalf. And so when something goes wrong, there's a fire at the factory and it's burned right to the ground. Rather than you, the owner, whether individual, partnership, or corporation, whether you suffer that loss, the insurance company will suffer that loss. So it's always good to have insurance.
Okay, so we'll take the rest of the questions, right after this next half of your presentation.
Yeah, so I want to go into the practical, but before I do that, let's look at quickly budgeting and taxation here. So a budget is a formal plan. So whenever you talk about a budget, it's not just an idea in your head, and that is it. When you talk about a budget, you want to have it written down in black and white, or whatever color ink you choose to use, and you want to be able to share it with other parties so people know what is it they need to do and how they're going to go about doing it. So when we have a business plan, and I know you spend some time in another session on business plan, budgets now is the quantitative part of that business plan. And just to let you know that for personal taxes, your tax at two levels, the feds and the province, and these are the percentages. It moves by about 46,000 in each bracket. So the first bracket up to 46, you pay 15% for Fed and 5.05 for the province. And then for each 46,000 up to 205. Anything above 205, you pay the 33 and the 13.6. And that goes about the individual and the family. Then the business one is the T2. So if you're running your business as an individual or a partnership, you will be faced with the T1s. And when you incorporate your business, you'll be faced with the T2. And these are numbers that have to be filed every year. And for the T2, in fact, for the T1, if you pay a lot of taxes each year, anything above $3,000, the government wants you to pay what they call installments. So every quarter when you do your business, you have to pay taxes over to the government. And then at the end of the year, when you file your tax return, if you pay more, you'll get it back as a rebate. and if you are a refund, and if you pay less, you'll have to pay the additional to bring it up to speed. Okay, so let's look at the cash flow now. Okay. I want to go to a different slide, and I'll get the slide to you guys after the session. So I'm going to send you guys a very elaborate worksheet after this. First of all, just be mindful that there's no template for cash flows or to do a cash flow projection. Every single business have its own nuances, and you can have a template that covers 90% of most businesses. But when I do a cash flow for client, I have to sit with the client, I have to find out what is it they're in, what is their business model, how the revenue move, how the expenses move, and based on that information, I design a process that will generate their cash flow. So normally there's a section on the cash flow that I call data, where I put all the variables that you'll have. So you can see here, it starts with some revenue, the initial revenue, etc. And this one was done for a chiropractor. And so we had various things here. So this part of the report just puts in the data, the different type of expenses you may have, and what are the variables that drive those expenses. And I tend to generate a financial statement. And I'm going to go real fast on these, and I'll come back to them. And this was a projection going out for 5 years. We started mid-year in 2014, and then we did a projection for 15, 16, 17, 18, 19. And you can do monthly projections, 2-year projections, 3-year, 5-year, 10-year, depending on what you think you need. So that's the P, profit or loss account here. And then this one is the balance sheet. This is the balance sheet I'm looking at here now. And the cash flow statement, this is what the cash flow statement look like. It will start with some net profit movements there, etc. So let's go to the monthly cash flow. And this is what I really want to leave with you guys. So a cash flow statement has 2 main components. It has cash that is coming in the business, absolute cash that's coming in. So we call it the cash inflow. And it has cash outflow. And then the difference between the cash inflow and the cash outflow will give you a cash balance, net cash flow. And if you have an opening balance, you will end up with a closing balance. So let me just go through that again slowly. Your cash flow would have 2 main components. There's a component that talk about cash coming in the business from whatever source, cash leaving the business from whatever source, and a difference between what's coming in and what's going out. Whenever there's no bracket around it, it means more cash is coming in than cash going out. When there is a negative sign, it means more cash is going out than what's coming in. And so when we do a cash flow, we keep our eyes on this section here to see to what extent these are negative. Because when these are negative, when you just do the cash flow, if all of this line is negative, it's telling you a number of stuff. First of all, it's telling you that you're spending more cash, or you plan to spend more cash than cash coming in. And so you have to start to look at the timing of that cash. Because, you know, sometime in January, you start with $0, but by the end of January, you end up with $100. but the money comes in at a different time. If you have to spend money from January 1st to January 30th, and then on the 31st is when you get the big revenue. What your cash flow allow you to do is that you have to find a way to have monies to pay second, the third, the fourth, the fifth, until cash comes in. So let's look at some of the items that we'll have with the cash coming in. The major one is the revenue. The major source of cash coming in is the revenue. So whatever business you're in, and in this case, we're doing monthly cash flow. We started October, November, December, ended in 2014, and then we go across January, February, March, etc. That ended in 2015, and then we just did annual cash statements after that. So let's take the month of October. When you start the business, you start with $100 in cash. And then you know you need cash to do stuff. So in this particular business, they got a loan of $100,000. So that is cash coming in the business. And then whatever sales they anticipate was $10,000 for that month. And so for the total month, they expect to have $110,228. So in your individual business, what you do, you look at what are the sources of cash coming in. You list all those sources and you put the sums of money that you expect from sales, from loans, from gifts, wherever you think money is coming in, you put it there. In this case, it was on 3 sources: equity that you started with, a loan, and from sales, from the operation. And that's a total. Then they look to see what are the things they have to pay. Salaries and benefit. And they identify they have to pay the receptionist. They have to pay the managing director. They have to pay some rent. And they go to what are some other general stuff. They have to pay back the principal on the loan. Remember that 100,000 loan? They have to pay back the principal on the loan. They plan to buy some equipment, some machinery and equipment. These are what you call capital assets. These will last some more than one accounting period. But they plan to spend $48,000 acquisition of property and equipment. Then some advertising, some bank charges, credit card interest, insurance that you keep asking about. So they pay this in advance, but they have to pay the $6,000 upfront. Then there's license fees and membership and dues, and then there's all the other stuff going down. And you have some professional fees, accounting fees, repairs and maintenance. So the total spending, total cash you expect to go out is $70,000. And so you have a net cash before interest and taxes. You don't have to go that elaborate way, but the reason why you want to separate interest and taxes is that in our legal system, you have to pay tax with cash, and most of the time you have to pay the interest with cash. You don't accrue interest. You can show that in your books, but you have to cut a check and give to the bank or whoever is the holder of that loan. So you want to look at this and say, okay, so from the operations itself, you're going to have $40,000, and then you have to pay interest on the loan. There weren't any taxes here. You pay the taxes later. And then that's the taxes in cash. And that's the net, which is the difference between this 110,228 and the sum of these two numbers. So you can see that in the month of October, because you got a loan, you end up with a positive cash flow. Now, if you didn't get that loan, if you didn't get that $100,000, look at what would happen. You'll be out of pocket by $60,000. And that's not real. Now, this could happen in real life, but what it means is that you wouldn't be able to pay for these stuff. You might have got there, so you can now plan. If there's no loan coming in, and this is how the cash flow help you, if there's no loan coming in, then you end up with a situation like this. And then you're now in a position to plan. You could say, for example, rather than you buy this furniture in cash, you can take it out on leveraging. You lease the truck or you pay for it down the road. So you don't have to use up cash up front to pay that. So you see you're still out by 12,000. You may say, okay, I'm not going to pay the insurance in advance. I'm going to pay it exactly when it's due. So that 6,000 is no longer there. And so you're in a better situation. And then you could go through and look for the different items here. Or what we did in this particular example is that we recognize that we're out of pocket by $60,000. So we got a loan of 100,000. We got a loan of 100,000. That will allow us to do all of this in October. This 39 is what you start the next cycle with. Opening balance is now 39,686, and the cycle start over. From your accounts receivable, these are people who owe you in prior period. You're going to get $102 from it. And you're going to get money from your sales, 9207. And so you're going to have 9309, and then you're going to pay these folks again. You're going to do all of these stuff. And what you see here is that you spend a little more in November than you receive, 5,000 more. It's that to pay the interest. So you see what happened here. In November, you spent 5,570 more, but you started with 39,000. And so therefore you still have 34,000 in the bank. And in December, you did the same thing. Now, how the cash flow help you? The fact that you got this loan of $100,000 in October, it allow you to finance your business right up to the end of December. And that's why I'm talking about finance, is how funds is flowing through the business. And so when you do your cash flow, it will tell you where you're having deficiencies. And it is showing that you're spending more in those months. But you see, you're still ending up with positive here. Now, eventually, you'll reach down to only $118 in the bank. And so in June of the following year, you're doing all of these stuff, and then you end up with 409. Can someone tell me how it's possible to end up with 409 in your banking system, in your cash system? Is that practical in real life? Any takers, Uju?
We just have people still asking questions.
Okay.
Someone asked, how do you estimate your sales for the revenue side of your cash flow?
Okay, beautiful, beautiful, perfect. So the sales you see here, I don't know if you can see the formula. I don't know can they see the formula, Uju?
Yes, I can see it. So if you wanna, move your cursor on where the formula is so people know where it is, but I can see it.
Okay, well, anyway, the question is, how do you do this? This is the knowledge of the business that you must have. Remember I mentioned over in the data here? This is where, and this is just for the worksheet template, but the answer is how you estimate your revenue is you have to know your business. Let's assume we go back to the HR case. You would have to sit and you'd have to anticipate, you'd have to make an assumption that for the month of October and November and December, what is the anticipated engagement you're going to have? And this is probably based on history, based on research, based on gut feelings, but you would have to come up with how many clients you think you will have, what is the type of work they may have for you, and what you can charge them for that job. If you're in a merchandising environment, like someone is selling spice or something like that, you would have to ask yourself, how many bottles of spice I think I can sell in these 3 months or in the month, and what is the price I'm going to sell them at. And that is where your revenue is generated from. So when I work with a client, I sit with a client and I ask the right questions. What is it you're going to do? How are you going to do it? What is the market out there? What is your market share, etc., etc.? And that is how you estimate your revenue, which is the major driver. When you're doing a cash flow, it is very, very important that you estimate your revenue. Remember I mentioned at the start of the program that revenue is vanity? That is what I mean. It's what you'd like to happen. It's the best guess, it's the greatest thing. Because your expenses, some of your expenses are discretionary. You can actually manage some of them. No, like the receptionist, you can't, because that's probably an employee or a contract person. The managing director, probably that's discretionary. If you're a sole proprietor or a sole practitioner, probably you don't pay yourself in a month when there's no money. Rent is not discretionary. Probably you're rented from a third-party person and you have to pay. So you have to look at these. You have to know your business to be able to project your revenue and to decide on what the value of your expenses are. Some is easy, some is not so easy.
Michael, we have like roughly 15 minutes. Do you want us there's still some outstanding questions. Do you want us to take the questions?
Yes, and I'll take all the questions and probably the questions will answer some of these stuff on the worksheet.
Okay. So I'm just gonna go back and talk on Natasha's question. You mentioned something about having internal controls in place when it comes to accounting and managing the books, and she's asking what are the examples of good internal controls.
Right. So good internal control has three elements. Three elements it has. Element number one is the authority to do stuff. Element number two is the segregation, is the performance. Who is actually doing what? And segment number three is actually who have physical custody of whatever you're doing. And each one of these three components need to be segregated. So when you look at your business transaction, there's three components to it. Who give the authority to do what, when, why, how, where? Who is actually doing the operation, the bookkeeping of that, especially the bookkeeping? And the third component is what is happening with the physical, either the item or the document you're working with. And if you can separate those three, let different people do it, you have very good control. So let me give you an example. So you're in the business of writing checks. You're writing checks to pay people. The person that authorized writing the check should be separate from the person that is actually writing the checks. And the person that keep the blank check, it's even better if a separate person keep the blank check. And so when you go to do like the bank recon, it shouldn't be the person that authorized, perform, or keep the physical check that does the bank recon, because you can have collusion, that sort of stuff. So a very good internal control is look at any aspect of your business, see who's given the authority to do stuff, who's actually performing the function, and if there's any physical custody of stuff, people who have keys and that sort of stuff, if you can separate those functions, you'd have good internal control. In a small business, it's very difficult because a lot of time it's one and the same person. The person you have doing the books is the person who write the check and do the bank recon. It might not be the person who authorize it, but most of the time the person have all the blank checks, do the bank recon either physically or in the computer. But what you do there is that you use other controls. Where you can have separation of duty, you use direct management control. So the manager, for example, would see the bank statement when it come in, and he can scan the bank statement. He'll probably see the return checks. If you have a budget, you'll compare the budgets to the actual to see if there's things changing.
Okay. Thank you. Kadeen has a question, and she says, as a solo entrepreneur providing a service-based business, should your compensation or salary be included in your financial statement? Also, any tips or strategies on how to pay yourself as a solo entrepreneur?
Okay, so first of all, as I've mentioned earlier, it's good to open a bank account that passes through all the item that has to do with the business, because you're a solo person and you're doing service. So every time you get paid for your service, pass it through the same bank account as the expenses that associate with it. So you should do that. That's one good way to keep track. Because when you file your returns, you're going to use a T1 that eventually is going to combine everything you do anyway. But if the government was to come to you and say, prove to me that this is a revenue you earn, the first thing they do is go to your bank account. And if the bank account is not separate, whatever money is in the bank account that came in as a credit, they're going to use it as your revenue. So you want to show them that, no, this is a bank account I use, even if it doesn't have the name, and you show all the transactions. In terms of paying yourself, you should make an effort to pay yourself. Look at what's market rate for whatever business you're in. Because sometimes when you work with yourself, you tend to underpay yourself or overpay yourself. So a good thing to do is to look around in the market to see what similar organizations, services that provide what you're doing do, and pay yourself. Now, sometimes there's not enough cash to pay you, but in accounting, you can accrue it. And that's for another lesson, but you should always identify that you're paying yourself a salary, actually pay yourself the salary. And then, you file your taxes on it, all your source deduction, etc. And you should use the market to determine what you pay yourself. If it's too high, the government will reduce it, but they won't move it up if it's too low. So look for market, pay yourself at market, and that will help you to determine whether the business you're in makes sense.
Awesome. Thank you. We also have Doreen, who's asking, what recourse do you have or do you take if your accountant does not file your small business taxes or write back to you?
Well, you may have to sue the person for malpractice if it's somebody like me that is a professional accountant, have an association that manage what I do. You can always report me to the CPA Ontario or CPA Canada, or or CPA in the US or CPA in Jamaica. And that is why I have insurance as well to cover stuff like that, because probably you didn't give me the cash to make the payment and I couldn't do it. But you can sue the person. That's a recourse you have. If the person is an employee, I suppose you have to fire that person. But if it's a contractor that's supposed to be doing good work, you can sue the person. But
Okay.
You're still responsible for the payment, not the person.
Okay. We have a question from Marlene, and she says, how do you accurately project future cash flows for the coming years?
Well, there's no such word. We talk about reasonable, because revenue is very difficult to predict. That's why we call it vanity. But what you want to do is to give it a good faith effort and ensure that you're probably in that 90 percentile, I'd say. But it can be done, You look at what is it you do? What is your business model? Remember, I mentioned that earlier. How do you make money? And you break out the money in the elements of the quantities and the fees or the price. And you try to make a good faith projection on what the quantities look like. So if you're in the service industry, you have to look at the client base that you have. Like each year I look at my client base and I say, well, okay, these clients probably going to return. These clients may not return. I look at who I should, I need to move up the fees on, who I'll keep flat. And that's the basis on which I project what my revenue will be in the subsequent year. But it's based on the best history. And I also say to myself, as part of my growth, I'm going to go to market to increase my client base by 2 or 4 or whatever each year. If you're in the business of selling a product, you want to look at the marketing results and the sales results that you have had over the last little while to see if there's a trend that is going up or a trend that is going down. You know, a year ago, selling masks would not have been a good business. But right now, selling face masks is booming. Probably next year it may not be booming because there's a cure for COVID and so on and so forth. There's a vaccine for COVID. So you have to look at those things, look at the market, do the SWOT analysis that, you know, when you're doing your business planning and your budget, that is where you spend time on. But it won't be accurate in the sense that's at 100%, but it must be reasonable and plausible. That is the term I would use. Don't sell $1,000 last year and believe you're going to do $1 million this year, unless you can clearly show that you're going to get a new contract that's going to bring in that $1 million.
Okay, just a follow up to that question. I just want to be sure that everybody has like very clear explanation on, you know, in terms of answers. So in terms of creating cash flow projections, like what are the parameters to look out for? Are we looking at for growth rates from competitors, or we're just looking at the trend, the industry trend and how it's going? Because I know you say that it has to be reasonable figures. So
it's all of the above.
Okay.
It's all of the above. You guys know, I think you probably did marketing and talk about a SWOT analysis. You have to look at external, internal opportunities, all that sort of stuff. So depending on what market you're in, you look to see if it's a growing market or it's a dying market. Like if you're in the business of selling buggy whips right now, that's a dead market. But if you're in the business of finding a vaccine for COVID, it might be a growing market. So it's all the above, it's everything, it's history, currently what you're doing and whatever projections you think. You might decide you want to grow your business by 5%. And as you do the projections, you realize the market will not grow by 5%. It may only grow by 2%. So you look at every single thing. And that is why, from an accounting perspective, when someone comes to me with an existing business, and say, let's do a cash flow, I go back as far as I can, 3 to 5 years, and I go through their financial statements. I look at what the average revenue was over the last 3 years. Is it growing? Is it declining? Then I have a discussion with the client, what is it you want? I look at the economic situation and I make an assumption, and you note that assumption. That assumption is built into, so let's assume, you assume that it's gonna grow 1% per month. You start with a good base and then it grows 1% per month. And that is where you get your revenue from. So you spend a lot more time on projecting revenue. And that's why I say revenue is a vanity. And cash flow is the reality, because even after you do that, I remember what the cash flow helps you to do is to see the cash flow position first. Then you can take decisions like, should I get a loan? How much should I get? When should I pay it back? And that sort of stuff. Because you want to have cash in the business.
Okay. One question, what role does inflation play in your future cash flow projections?
Very important role, because you should be growing by at least inflation. Because if your expenses are growing by inflation or worse, and your revenue is not keeping pace, eventually what you'll see is that you're doing business at a loss. Probably the first couple of years you don't see it, but eventually it will play out. And when you do costing, there's a stuff they call a break-even analysis that you do. And that will tell you what is the quantities and price that you need to be selling at to ensure that you're not losing. So inflation, a lot of organizations at the very least move up their revenue by inflation, or sometimes a couple of percentage points above inflation. So it's very, very important.
Okay. All right, just going back to some of the questions here. Marlene is asking, sorry, I think I've lost track of just a lot of
Would you just a second? Janine wanted a question and she wasn't able to type it into the chat. So she wanted to come on camera and ask a question. That's Janine.
Yeah, I'm good. I'm good if you can't put it in the chat. I'll take all the questions.
Thank you so much for that. So hopefully you can understand my question, but it came about because you were speaking about loans and resources that we can have access to. So as a self-employed paid entrepreneur under a corporation. So this is my husband and I, we own the corporation.
Mhm.
Question is, how long does it take for like a financial institution to see me? Because if I'm a paid employee under the corporation, how long does it take for them to see me as valuable, like that income as a revenue coming in order to like qualify for a loan or a mortgage or something like that? How do I?
So how you should structure your relationship in your own company?
Mhm.
You should ensure that you're paid a salary and you generate your T4 each year. Because the banks are interested in the T4s, not in your T1s that you filed. It's just one of the anomaly in the bank. So you and your husband is in partnership doing what you're doing.
Yes.
So you're an owner, manager, employee. Ensure that the employee component is actually paid as an employee. So you do T4s and you send over the source deduction on the 15th of each month to the government. And at the end of the year, you get a T4 report and you file your taxes. Then you take those T4s to the bank. Because when you go to the bank as a self-employed now, they have very little faith in the reporting income. There's just something about the bank right now that they don't believe people running their own business is capable of getting a mortgage. That may change eventually. But a way around that is to actually pay yourself a salary and have the T4 to demonstrate.
Okay, so my follow-up question with that, thank you for answering, would be, with your experience, have you seen it be like you have to do this for like 2 years straight, a year straight, or more?
No, it depends on the bank. You know what a lot of banks tend to say, show me the last 2 pay slip or 3 pay slip. But they may also go forward. They may want to say, show me your cash flow projections. And if they look there and they don't see salaries coming out, they'll ask a question. So you should really, I can't answer for the bank per se. But what I do know is that the bank prefer T4s than statement that you own companies.
Thank you so much for that.
You're most welcome, my dear.
Okay, we have one more question, and that is, yeah, I like this one. And it says, what are the key things that banks look out for in financial statements? So when you're going into the bank and you're asking for a loan and you're showing your cash flows, and what are the key things that they look out for? Apart from your business plan, what else do they look out for?
So the bank have their own criteria. They call it beacon score and all sort of stuff. They have that. But from a straight viability, what the bank look for is this business viable enough to repay the loan? That's what they're looking at. So when you present to them your balance sheet, you want to ensure that the balance sheet is robust. What do I mean by that? It is solvent. So your obligations are much less than your assets. Remember that equation where I see the assets at the top and the obligation is at the bottom there. You want to ensure that if you've got $1 million in asset, you don't have $1,001,001 in liabilities. They want it to be the other way around. It means that you're solvent. You can easily pay your liabilities without going bankrupt. What they also like to see, depending on the type of business you're in and so on, is your cash base. If you're liquid, if when they look in your cash account or your bank account, they see, so as part of your assets, what they want to see is that you have more liquid assets. So if you're in a manufacturing business, for example, and your total asset was say $1 million, they don't want to see inventory as 800,000 and cash is 200,000, because inventory is not liquid. You have to go sell the assets. Remember, Nadine gave us an example earlier. Having been to the White House, you had to give away her goods.
Yeah.
So you don't want to have that. So the bank look for that. So that's what they call liquidity. And there's some other tests. But the key thing is the business viable to pay back the loan? So what we would do is we do a cash flow like the one I've got here. And you want to show them on that cash flow that each month there's cash to pay back their interest charge. If you go back to this I've got here, go to the end, you'll see interest. You want to show them that that line item there have their interest payment. And you want to also show them that the line item at the top, line 27, has the principal repayment. And at the end, there is positive money down here. Or if it's negative, it's not consistently negative. So you want to do a cash flow like this, and you want to call out, you might even bold it up. When you go here, you might bold it or put a color code across it. These two lines is what you want to do. So the bank can see that their interest, which is the principal, and the interest is being covered on a monthly basis. And you still have positive cash flow down here.
But,
and then the bank, sorry?
Okay, I was going to ask a follow-up question on this. So this cash flow is on the assumption that there is already a loan that is running. But what if
not necessarily. I just wanted to. This one has a loan, and I remember doing this one, and we did this one after we saw the cash flow. I would look. In fact, we went to the bank to get the loan. I wanted to show that this loan would help us to do what we need to do. That is why we need 100,000 at the time. So a lot of times when you do your cash flow, loans and so on is not in it. It's just purely from operations. But then you look to see that if you remove that 100,000, you'll see that don't have cash to pay the liabilities as they fall due. And that is why you want the loan. But having got the loan, you also want to demonstrate that having got that loan is still running your business. But remember the revenue here. This is the line that will drive your business. If you're not bringing in revenue, loans are just short-term stopgap. You have to earn your way out of loans. So this line here is what you want to spend your attention on to ensure that the revenue line is increasing or is stable enough to support all these expenses down here and still give you a positive cash flow.
Awesome. We have one more question, and someone was asking if this sheet will be shared. Yes, it would be shared as a template that you can work with. But like Michael said, there is no one template. Everything has to be customized to your business and what your cash flow looks like. So we will share this after in the coming days, and then hopefully you should be able to work with it. And if you have any questions, you can send it across, and I will pass them across to Michael.
Yeah, and notice on this thing, under the section which says data here, here is where a lot of, someone had asked a question, how do you estimate your revenue? This whole section here is where I sit down with the individual client and we walk through what are the factors that is driving not just the revenue, but also the expense type. Because you have some expense that is driven by time, some is driven by hours, some is driven by task. So we put all of those assumptions inside here, and then it goes ahead and it generates the financial statements that we require and the cash flow. And I've designed this so that everything balanced. You can actually do what they call what ifs down here, scenarios. If this change or that change, what will happen to the various numbers. But this basic statement here starts with a cash inflow, cash outflow, net change. That is what your cash flow is. You think of all the things that's bringing in money, all the things that money will go out, and you can actually time some of these stuff. Like as I say with the insurance, you have a choice to pay the insurance in advance or to pay it on the day in question. So let's assume that this 6,000 was really to begin in November, but the insurance company want you to pay it in October. You could actually wait for the 1st of December and pay the check over here in November, and that could save you spending $6,000 in October. That's the purpose for the cash flow. So you can see a big picture of what's happening, and you can take management decisions to change it. Now, the revenue is the one that is difficult to change, because that has to do with selling stuff or getting engagements, and you really don't have controls over those stuff.
Okay. Doreen asked if the replay of this video will be available. Yes, it's usually posted on our YouTube channel. So I would just advise, to just stay tuned, and when it's updated, I would let you know, or you can just click the notification on the channel so that when new videos go up, you would know. Let's see. Any more questions? I think that's all of the questions that we have for today. We had a lot of questions. Really.
No, and it's good. I just want to say to folks, if you're having a little challenges understanding it, don't beat up on yourself too much. I've been doing it for more than 40 years. So one night, an hour and a half is not good enough, but hopefully it will set a basis so you can start to question what you do. Because even if you retain a professional to do your cash flow, that professional has to sit down with you and ask the right questions. So if you get someone to say they're going to do a cash flow and they run off in the wilderness and come back to you with a cash flow, ask yourself if it's money well spent.
Mm-hmm.
They need to sit with you and pull from you, what is it you do, how you do it, what is your own feelings, what's happening. Then they can put together a cash flow. Very, very personal, very, very specific.
Okay, there was someone asked about, I can't trace the question now, but I remember seeing it. Someone asked about if this session can be done in smaller groups, and that is the segue through which I will talk about BAIDS, which is the Business Advisory Implementation and Development Services, which just launched a few weeks ago. So that program is more like a consultancy service, which we're so happy that Michael will be a part of as well. And so I advise you to sign up for that one. That is more in-depth, is more one-on-one, so that the nuances of your businesses and the particular challenges of your business can be addressed by the professionals that form the consultancy team of BAIDS. And so yes, your question, we would do this again in smaller teams, but you need to be registered and you need to be a BBPA member to do that. In terms of becoming a BBPA member, if you're not already, please go on the website and find directions on becoming a member. On that note, thank you so much, everyone. Thank you, Michael. You have been incredibly helpful. I have learned a lot, and I know the women on this program have learned a ton as well that can be implemented in their business going forward. And so for the homework for this week, I see someone asking about homework for next week. I love it when students are so eager for homework. Like I wasn't like that as a student. I'm always looking for ways not to do homework. But anyway, the homework for this week is I'm just going to share my screen now, but I'm going to work.
So let me stop share.
Okay.
And just before we run, just want to thanks for having me. It's always a pleasure doing this stuff, and I do like the questions, because a lot of time it is through the questions, if people, if you make sense or people understanding what you're doing. I tried to walk on water, but it was dried outside, so I just walk on the concrete. I hope I didn't make a liar out of my president. So thanks for having me.